Welcome to this episode where we'll be talking about claiming Social Security benefits. This is one of the topics that we have the most questions on with clients as we sit down initially, and then also one of the most viewed topics that we have with the YouTube channel. And so we're excited to dive back in, talk about how we think through this decision, both as an individual filer, and then next time we'll be talking about how to grapple with the claims that you might make as a couple looking at your benefits. So as we dive in today, I want to frame things big picture, and that's that we've got three basic considerations. First, we've got to know the elements of Social Security. How are they calculated? What are the moving parts? If we retire at one age versus another, how does that impact our benefits? Those different key pieces. Once we know that, then we've got to set a list of assumptions, and these will be best suited for your particular situation. Every situation is different, and we don't know our longevity, none of us. And so that also introduces a level of complexity. But if we can come up with good assumptions, then that at least stacks the odds in our favor. So we think about the longevity that we have, both individually, and then if we're married, the longevity as a couple. We think about cash flows, when those income streams would be helpful to have. Also, the value of inflation protection. It is more valuable than you might think, particularly if we're thinking out in a multi-decade period. We also want to consider taxes and other income. This is a lesser consideration, but it is still one, because sometimes when we claim, tax bill can be much higher than it needs to be. And so we want to think about how this relates to the overall financial plan and how we might be able to structure it optimally. And then we also have to recognize that at this level now that there is some consideration to the fact that the United States government continues to run a huge deficit. We don't think that the default risk is significant. We don't think that Social Security benefits will be cut, but we also can't avoid that question as we sit down and as we talk with clients. And so we need to set an assumption there that it is in fact going to pay out over the course of our lifetimes, or to make some kind of a hedging element there as we look at those projections. The final thing that we want to come back to is grappling with when the money income stream is going to be the most valuable. So psychologically, some clients will say, it's going to really help me if I can have this income stream earlier. It'll help me to live and give, be more open-handed with these resources if I can claim at an earlier age rather than a later age. And this can be a significant piece to the financial planning process as we grapple with this, because it can actually allow people to fulfill more of their goals, their dreams, even their gifts to different people and institutions if we factor this in. And sometimes it gives us an outcome that would be different than what the statistics or what the numbers would suggest for a long-term level of income, but we need to make allowances for that. So that's where we're headed today, is we want to look at each one of these different pieces. So if we think about a basic review of how benefits are calculated, Austin, can you walk us through how they're calculated, how we come up with this primary insurance amount, and what we think about in terms of a full retirement age these days?
Yeah, absolutely. So at a broad picture, you can watch our video about how these benefits are calculated more in depth. But what Social Security is going to do is they're going to look at your 35 highest years of earnings indexed to inflation. And so there's a calculation that they'll do that brings up certain years. It may take some years down based on what the inflation rate was at that time. Once they've got that, they'll divide all of those years by 35 and then divide that by 12 to get your average indexed monthly earnings. And then from that, they've got various bend points. And so from your base to that first bend point, you receive 90% of that as your benefit. And then between the first and the second, there's 32% that is added to your benefit. And then the last piece is 15% from the final bend point up into the very top of the monthly index earnings that you can earn for your birth year. Once you've got that, there's various adjustments for inflation and cost of living adjustments that are done between the time that your AIME is calculated and the time that your primary insurance amount that you start actually taking in, then you add in deferral credits or early benefit credits. So there's quite a lot that actually goes into the calculation, but that's kind of a broad overview of how we come to it.
So again, they come up with this primary insurance amount that is the amount that you would receive if you claim at your full retirement age, given some general assumptions that are put in place there as well. If we think about the claiming strategy and whether you claim earlier or whether you claim later based on that primary insurance amount that Austin just talked through. If we claim at age 67 versus age 62 or 70, here's a visual. So let's just say that you were going to have a monthly benefit of $1,500 if you claimed at age 67. Well, if you claim at age 62 and your full retirement age again is 67, there's going to be a haircut of about 30% of the value there. Now, the good news is, of course, you're getting that benefit earlier, but you only get $1,050 starting at age 62. Well, if you knew when you were going to pass away and you're going to pass away at age 64, obviously claim as early as you can, get as much benefit as you can. Now, the caveat here as well is that if you're still employed and you have earned income and it's north of about $20,000 a year, then there is a bit of payback in there as well. The Social Security Administration is going to say, if you make too much money, we're not going to be paying out benefits at that same clip. So that's one thing to be aware. That happens up until your full retirement age at age 67. So you can make $1 million or $10 million or however much money you want there beginning at age 67 or your full retirement age and not have any kind of clawback of those benefits from Social Security. So just like we talked about, if you claim early, 5 years early in this example, then you have a 30% haircut. It's a sliding scale. And so every month that you claim early, your benefit is decreased just a little bit. If we think about the other side of things, though, every month that you defer claiming from age 67 to age 70, you see those benefits step up a little bit, such that each year that you defer, you have an 8% step up in the value of those benefits, in addition to any cost of living adjustment that you'd have put in place there. So in fact, there's a 77% difference in the income stream that you would receive on a month-to-month basis between age 62 and age 70 in this example. So a pretty significant difference. Now, if we think about this big picture, again, there are some scenarios where you should absolutely claim at age 62. If you knew that your life expectancy was only 2 years and you were contemplating whether at age 62 you're claiming benefits, definitely take them then. If we had a life expectancy by contrast of 95, then we'd want to encourage a client potentially to defer those benefits just based on, again, the value of that income stream over time. So here's a quick break-even analysis. If you look at the left-hand side table here, this gives you the age and some breakpoints there of both men, women, and then couples. So if you looked at it and you're age 62 and you're a male, then you have about an 85% chance to living out to age 70. You have about a 53% chance living out to age 81 and 18% chance living to age 90. Now, this is the general population. And if you didn't watch our last video, go back and look at that. If you are age 65 in kind of average health with the demographic that we typically serve in terms of having a higher level of income, higher level of education, more access to healthcare, then your life expectancy will be significantly longer. It might be 6, 7, 8, 10 years longer. So what we would typically see for someone who's age 65, kind of an average health, not a smoker, and not diabetic, would be that their life expectancy actually would be into their early 90s among, again, the demographic that we would serve. So it's really important that as we look at this break-even analysis that we're using a correct view of the tables here. But again, this is general population. This is where a lot of people will start in terms of their analysis, because this is what they've heard the financial media spout. This is what they've heard maybe their friends or family talk through. And so we did want to start here with the recognition, again, that you're probably going to live longer if you are kind of in that average health demographic that we tend to serve here in East Tennessee. If we look at women, they tend to live longer than their male counterparts. Again, a higher probability that they live out to age 81 and 90. And then as a couple, a married couple, you would find, again, that likelihood that at least one spouse or the other is going to live out to age 81 is quite high. 84%, even among the general population where longevity is not as pronounced, and looking out to age 90, again, almost a coin flip there. So on the right-hand side, you see there a break-even chart, and put this together for a random individual that we'll call Joe. And this gives you an idea of the income stream that he would have if he claimed as early as he could at age 62 versus at age 70, and where that break-even point tends to be. So we pulled this off of Social Security Timing, that website. It is a proprietary set of software that we use to help clients look at a break-even chart like this, or kind of the optimal analysis of when they might be able to take Social Security. But if he was a 62-year-old man with a primary insurance amount of $2,500 and was projected to live out to age 85, without any kind of discounting rate there, 0% discount rate, you could see that that break-even point there is around age 81. So we're not looking at this in such a way that we're saying he's going to live out to age 95 or age 100, nor is he going to pass away significantly earlier, say in his late 60s. We're looking at this as kind of a core example. So you can see, again, that crossover point tends to be early 80s. And if he lives out to 85, then the suggested strategy, again, would be deferring to age 70 and then having benefits that would be, again, above and beyond by, say, his early 80s. Now, as we talked about, those life expectancies that we see via the overall population and what we see with Social Security and their projections and some of the financial media, their projections, they're just not quite as accurate as what we'd like to see. So I did put together here in this example, if you're 65-year-old man, let's say 5'10", 190 pounds, and married in good health. So on a scale of 1 to 5, that's a 3. So good health as opposed to excellent health, which would be a 5, or poor health, that would be a 1. If you do 3 or 4 workouts a week, you have 2 to 7 drinks per week, you're a non-smoker, retired, and had good income during your working years. So the final part of your working years, you made on average $80,000 or above. You're not a diabetic. You're don't have that ailment, and you're a college graduate. All of those different pieces together would come together to suggest that your longevity, again, is looking out to an estimation of age 92. So quite a bit of difference there relative to what Social Security would come up with the general population, which would be about 10 years less than that. If you look at the life expectancy probabilities there on the right-hand side, if you're age 65 today, and we look at those who are non-smokers in excellent health, again, that would be the highest bars there. For women, there's about a 72% chance that you'll live out to 85. There's a 54% chance that you live into your 90s. And then about a third of all women in this category would live to 95. So a substantial amount there of longevity, I think beyond what most people would understand or grapple with. Even for men, again, just in excellent health, non-smokers, again, we'd say north of 43% of a chance for men achieving the age of 90. And then for couples, you would look at it and say, there's almost a 50% chance that one or the other would live to 95. So significant longevity there. This doesn't even factor in all these other elements that we've talked about in terms of being a college graduate, the number of workouts or good health that you might have. Actually, I take that back. It does include being in excellent health, but it does not include the level of exercise or being a college graduate or the level of income, all which would stack the odds in our client's favor. Again, if we think about the average demographic that we work with. So that's one of those core key assumptions that we talked about that we need to make as we think about when to claim Social Security benefits. And this is something that's not really talked about, I don't think, enough, is the level of longevity that we're seeing in our population right now, and the probability that you're actually not going to just live into your 80s, but even 90s and beyond, at least one person within a couple. This is a nice visual in that it gives you an idea of expected longevity and that expected annual rate of return in there. And so I would look at this and say, okay, if your expected longevity there is, in terms of age, is on the x-axis or the horizontal part of things, and then the expected annual rate of return is there vertically, what we would say is it's not really fair to expect an annual rate of return on something that's as stable as Social Security income of anything beyond, say, Treasury rates over a long period of time. So we would caution going above and beyond, say something like 4% here. So that would put the expected longevity there, that break-even point, maybe at age 82, 83 for claiming at age 70. You can see there is a band there for claiming at full retirement age versus, if we had someone that said, well, I know I can get a 10% rate of return, well, then they probably want to claim at age 62 because the time value of money calculation really skews the odds in their favor there if they're getting a rate of return that's so far above and beyond inflation. Again, what we would come back to is cautioning there, and particularly looking at both spouses if we have a married couple and their overall longevity and what's expected. So with those different pieces, again, if we go back and we think, what are the key assumptions that we need to make? It comes down to what's the longevity that you have? How do we think about the level of income that you'll have there in terms of inflation protection? The other piece that we always come back to is some tax planning. Now, this is not going to skew things very much one way or another. It might encourage, if we're right on the borderline, it might encourage a person to defer taking income or taking earlier. We did a video on this earlier in terms of talking about the tax planning ramifications for Social Security income. There are situations where it makes sense to take earlier if you're right on the cusp of making a decision there, just based on having a lower level of taxation based on many years of benefits. There it can make sense to take it earlier. But generally speaking, the tax planning situation is improved by deferring Social Security benefits. And for a lot of our clients who are in their early 60s right now, they may have 5 years worth of really strong Social Security benefits from age 70 to 75 before they're really having to tap into those required minimum distributions. And that can be an excellent way to garner the most on a net basis for Social Security because those benefits are taxed in a different way and taxed in an advantageous way. So that can be one of those additional elements that can skew in the favor of deferring benefits if we look at it. Now, as we think about this, though, this last factor, determining the value psychologically of early income, there's a lot to unpack here. And this is one that can really change the dynamic of how a client chooses, even if they see a level of income that is going to be stronger and might even be six figures in terms of the difference projected just by deferring. So, Austin, when we think about the psychological value of taking early income, what's the feedback that we get from some of our clients?
Yeah, I can think of several clients that we've spoken to within the last year that have been approaching retirement or they had just retired. And for them, they have received a constant monthly paycheck that is predictable, or every other week they know it's going to come in. And the psychological benefit from them to have that income from Social Security that they know I'm getting a paycheck every single month, there is a benefit to that. This is in the context of an entire financial plan where we say, let's look and see with your investments, can we continue to give you that monthly benefit, that check that you receive in the mail as though income is coming in? You'll see your retirement accounts, they may dip a little bit because you're taking those funds out depending on that rate of return that you're garnering. But for a lot of clients, it's the jarring effect of I've worked my whole life, I've received a paycheck, and now I don't have that paycheck from my employer. So how am I going to make that income back up? And so I think Social Security, knowing that it's funded by the federal government, there's a little bit more security that you feel in receiving that income benefit.
Well, and you bring up a good point. It being funded by the federal government, we do have clients as well that say, how long is the strength of this benefit going to stay the same? And so we can walk through and say, the best of our planning, the best of our conversations that we have with legislators, the best that we can see is that benefit's not going to be cut. There probably will be some kind of change, made to the calculation or the taxation to Social Security over the next number of years, but we can't guarantee that benefit is going to be there. And so, as we look at that, if there is a haircut of a benefit, then clients, psychologically feel loss twice as much as they appreciate gain. And I think that is one of those other elements that on the balance, clients say sometimes, well, I just want to make sure that I get as much as I can from the system before the system changes. So we think about the psychological value really in two different parts. One is the value, Austin, that you were unpacking, which is I want to be able to get a steady income stream earlier. I want to see it come in on a consistent basis. I want to know that it's going to be there and it's going to grow hopefully a little bit each year. The other thing is there can be a fear of loss, of that the value of that income stream over time. And so taking it earlier gives people sometimes a little bit more sense of security that they're doing everything that they can to get some of the benefit. Now, the contrast point again that we would say is that even if that benefit changes a little bit down the road, there's a high likelihood that deferring that benefit can help in the financial planning, and particularly as we think farther on out. The psychological value of early income we have to grapple with, because we're also thinking about that question there that's point B, will it put your financial plan in jeopardy? So if we're in a situation where a client has plenty in terms of income, maybe it is Social Security, pension, assets that are saved relative to their standard of living, relative to what we could project with respect to expenses on a month-to-month basis, and even end-of-life expenses that they might need for long-term care, those kinds of things. If they have plenty that's there, then this question is not as significant a question. But if we find that their financial plan is running things pretty tight, they might get out into their 90s and it may not have quite as much as they'd like of consistent income, then we want to really come back and say, okay, if this puts your financial plan in jeopardy, if all you had left was a Social Security income stream, and we could say, well, you're going to have $4,000 on a month-to-month basis if you defer, rather than $3,000 a month if you take at full retirement age, or maybe even $2,500 on a month-to-month basis if you take at an earlier level. Are you okay with having that lower level of income? Because for a lot of our clients, that level of Social Security income, if they maximize it, can give them the base level of income that we're kind of projecting them to need over a long period of time. But if they take a haircut of that, oftentimes clients say, I really can't imagine having to live on just that lower level of income. So we've got to say, okay, does this potentially put your financial plan in jeopardy? If you saw assets, being spent down over time, that extra, could be $100,000 of income that you would have there if you do live into your late 80s or 90s. Is that material to the plan? And if it is, then we really have to grapple psychologically with, okay, is the value of the early income, is that greater than the concern that maybe you could have less later on or run out of other funds to be able to use and just have that lower level of Social Security? So the psychological value of early income really has to be juxtaposed with the concern about having enough later on. The final thing that we would come back to that tends to be a secondary concern is, how concerned are folks about passing on wealth? And if this is a situation where a client says, well, I just want to be able to pass on as much as I can to family, to charitable institutions that I'm passionate about, I know that I'll have enough for my lifetime, then it really makes this conversation much easier, because we're just looking at the mathematics of it. If they're really concerned about passing on resources and maximizing those, then we're really looking at a long period of time, and we're trying to make sure that those income streams are spot on in terms of the financial planning. And we're looking at that longevity calculation at a much more granular level to make sure that we're not missing anything there. So if that is not a concern, though, if that's a much less concern on the overall scheme of things, then sometimes that early income can be helpful, because again, it gives a level of latitude, a level of flexibility in terms of living and giving, whether that might mean that they'd take an extra trip earlier in retirement on an annual basis, or whether they'd make extra gifts to grandkids or charities. Then that can sometimes be a greater part of the equation, where claiming again early can be helpful. Austin, as we wrap this up, any other thoughts that you have?
What I would say is, as we come back to this again and again and again, really it comes down to what are those desires and goals that you have. We cannot determine the optimal Social Security claiming strategy for anyone within a vacuum. really we have to know what are those life plan? What are those goals? What is your expected longevity? But let's actually take that in context of your lifestyle, your income, your education level. Really, Social Security timing is not as black and white as media wants to portray it to be. And so really work with your financial advisor. Clients, if you want to talk to us about Social Security timing, we want to have those conversations with you. We want to unpack the pros and cons. Don't just take whatever the media says and say, I'm going to run with that because I want the income now. You don't want to sacrifice your long-term financial success based on an article that you read online. So really work with an expert to figure out what is going to be the most salient strategy for you, for your goals, for your family, and for the wealth that you've built over time.
Super. Well, with that, we hope you found value in the video. If you have any questions, please leave those in the comments or reach out to us. And until next time, take care.
If you like these financial planning videos, please share it with a friend. And if you have questions, go to our website at SeriousRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SeriousRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.